Today, we reveal our 50% per year investment portfolio that we've set aside for retirement. What's up, guys? I'm Mike.
And I'm Brit.
And this particular portfolio is inside of our Roth IRAs.
And if you're unfamiliar with what a Roth IRA is, it's basically where you can put post-tax income and it will grow tax-free.
So basically, income that you've already paid taxes on, you set it aside in a Roth IRA, and you don't have to pay any taxes on the gains. So you can set up a Roth IRA if you're single, earning less than $125,000 a year, or married, filing jointly, earning less than $208,000 per year. Those numbers are up a little bit from last year. Okay, so basically, our Roth, we started in this past November. It's now mid-February, so we've had it about 3 months.
There were some goals we had in mind when we first started this portfolio. One was to keep it simple and mainly hands-off.
This is also not going to be our main investment portfolio. We have other ideas in mind to be like our main investments, but this is just something that we want to have that we can fall back on if everything else we try to do investment-wise
fails.
You know, the riskier stuff, if it doesn't pan out. So for the most part, this portfolio is going to track the market going forward. And we have a couple of funds in there that are a little bit more aggressive. So another one of our goals with our Roth IRA is to slightly outperform the market over long periods of time. Statistically, as you guys probably are well aware, this is not likely to happen, but we're going to try anyway.
So with all that being said, the three funds we have in our Roth IRA are VTI, VUG, and VGT.
So all of these are ETFs. And if you're not familiar with what ETFs are, they basically mean, ETF stands for Exchange Traded Fund, and it's almost the same thing as an index fund. They're like index funds broken up into shares. So with ETFs, you buy and sell shares in the open market instead of just investing in an index fund however much money you want to. Bernie and I actually made a video about ETFs versus index funds versus mutual funds. I'll link it up here if you guys want to watch that. So VTI is Vanguard's total stock market ETF. And that represents 50% about of our portfolio. The reason we want it to be 50% is because we want the majority of our portfolio, like we said before, to track the market. VTI in particular has been up about 200%, a little over 200% over the last 10 years, which equates to about 11.2% year-over-year return for the last 10 years.
So the next fund in our portfolio is VUG, and that's about 25% of our portfolio. And that stands for the Vanguard Growth Index Fund.
Yep. So growth companies are basically companies that have a lot of cash. They're making a lot of cash. So think of companies like Apple, Microsoft, things like that. I'm pretty sure Apple and Microsoft make up like the top two, definitely the top 5 holdings of this ETF. But VUG has returned about 315% over the last 10 years, or 14.4% year-over-year return if you want to like average that out over the last 10 years. The next fund, making up the last 25% of our Roth IRAs, is VGT. This is Vanguard's Information Technology ETF. So basically think of companies like, again, Apple, Microsoft, Amazon, just basically tech companies. This particular fund is up 472% over the last 10 years, or about 17.7% average year-over-year return, which is very, very good for the last 10 years. So both VGT and VUG have well outperformed the market as a whole over the last 10 years, which is one of the reasons Brit and I have put these in our Roth IRAs, because like we said before, we want to try and beat the market a little bit. I don't think that information technology companies and growth companies are going away anytime soon. In fact, my opinion is they're just going to keep performing the way they have in the future, because we have markets emerging like cloud-based computing, artificial intelligence, companies that do things like that, which I'm sure will be put in this information technology sector eventually. So basically, if you look at those funds over the last 10 years and make a weighted average based on our portfolio, we could expect about a 13.62% return going forward. Although past performance doesn't ever guarantee future results, but that's pretty much the only metric we have to go on. So if you take basically an average of the year-over-year returns for each of those funds the last 10 years, weight them to our portfolio, that's where you get 13.62%, or that's where I'm getting that number. So combine that with about a 1% dividend that we should be getting overall out of all 3 of these funds, because they pay dividends quarterly. That puts hopefully our expected growth going forward at about 14.62% year over year.
So if you do qualify for a Roth IRA, you can contribute up to $6,000 per person. So that's what we did.
Yep.
So our total came out to $12,000. So $6,000 for me and $6,000 for Mike. So with Mike's first $6,000, it grew to $6,845.18. We have it written down. And in my portfolio, it grew to $6,855.93. So that's a gain of $1,701.11, which is 14.17%. And our current market value is $13,701. $2.11.
Yeah, so we've grown a little over 14% in the last 3 months since November, which if you project out for the rest of the year, that's 56% growth year over year, which is not going to be sustainable long term, I'm sure. That's very aggressive growth. I mean, hopefully it will be, but probably not. So that's where the title of the video comes from, 50% year over year. So one of our goals that we did mention before is to have a $1 million investment portfolio eventually. With the numbers that we mentioned in this video so far, to hit that number, we basically have a few different timelines we can look at. If we want to hit $1 million at the current rate, the 56% per year that we're growing at right now, it will take 7 years, 9 months. And that's assuming that we don't contribute any more to our Roth IRAs. 7 years, 9 months, not bad.
Yeah.
If we assume the previous 10-year growth rate, the 14% year over year, then it's going to take us about 29 years if we invest the dividends. And if we just assume a flat 10% growth rate year over year, reinvest the dividends after that, it's going to take 39 years and 2 months. So we're going to be well into our 70s by the time that happens, which...
that's something we don't want. So we're trying to be a little bit more aggressive. Yeah.
So like we said before, our Roth IRA it's not going to be our main investment portfolio, but it is something that we did want to set up just in case nothing else works out. We probably will fund these a little bit. We may not max them out year over year, even though that would probably be the best scenario. We just don't have, as of right now, we don't have all that much extra cash at the end of the month to be investing. We could probably max out our Roths and have a little bit left over to invest in other things. But we want to be really aggressive with our investing. And we'd rather be aggressive, at least with the way we're thinking right now, we'd rather be aggressive with our most aggressive investments, if that makes sense. Which of these are not them. So in the future, we probably will be making another video about our other investment portfolio, which we haven't even funded yet, but we're trying to strategize, what companies to pick. In this portfolio, we're probably going to be investing in like individual stocks and things like that. So be on the lookout for that video. That's going to be coming in the next month or so, I would imagine. Hey guys, Editing Mike here. So at this point, you may be wondering, well, why not just put like the more riskier / aggressive investments into the Roth IRA? Take profits whenever we can, reinvest those profits into the funds we mentioned earlier. And then that way, like since everything's done in the Roth IRA, everything grows tax-free, and that way all the gains will be tax-free. And this is something that we have thought about, but a huge goal of Brittany's in mind that we didn't mention in the video is that we really want to be able to retire before we reach 59.5, which is the minimum withdrawal age that you can withdraw from a Roth IRA without penalty. So we'd like to have access to any capital gains or any dividends that we could use as income really whenever we want to, as early as we want to. And at that point, we'd just be paying the regular capital gains tax rates on everything, which is substantially less than our current tax rate. So I wanted to clarify that point real quick. Not to say that we won't be putting like more aggressive funds in our Roth IRAs in the future. We may, but as of right now, we want to kind of play around with those in just a regular brokerage account.
And with all that being said, thanks so much for watching. And if you enjoyed the video, please give it a huge thumbs up. That helps the YouTube algorithm, and subscribe for more. Also, if you want, you can follow us on Instagram at It's Mike and Brit.
Yep, we post there every now and then. And with that being said, we'll see you guys next time.
Bye. So with all that, thanks so much for watching. And if you want to...
So you can set up one of these portfolios. So you can set up a Roth IRA. You're good to withdraw your gains tax-free. That's it.